Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. What a ride the markets have been on lately.
Definitely.
It feels like every day brings a new headline, a fresh policy pivot, and just when you think you've got a clear read on things, well, the picture shifts again.
It does.
Cutting through that noise to understand what's really driving things right now, that's the challenge.
It really is. The volume of information can feel, well, overwhelming, and it's easy to get whipsawed by conflicting signals. Pinpointing what holds the most weight for markets and the economy is key.
And that is exactly why we're here doing this deep dive. You, our listener, have shared a stack of recent financial news headlines and reports from major outlets: Yahoo Finance, MarketWatch, CNBC, Reuters, Bloomberg.
Good mix.
A really good mix. Our mission today is to go through this material together, to extract the most important nuggets, the key insights, and maybe the surprising perspectives to give you a shortcut to understanding the forces at play this week.
And as we dive into this, it's crucial to mention that some of these sources touch on politically sensitive topics, particularly around, trade and tax policy.
Right.
Our role here is purely to impartially report on the content of these sources. We're here to convey the ideas and information presented in these articles, not to endorse any specific political viewpoint or take sides.
Absolutely.
We're your guides to what the sources are saying.
Think of us as just unpacking the facts and the arguments within the material you provided. Okay, let's jump in. So, running through many of the sources you sent, from Yahoo Finance to MarketWatch and CNBC, is this central theme: volatility driven by trade policy, specifically U.S. tariffs. It feels like that's really setting the tone right now.
It absolutely is. And MarketWatch highlighted a concept that's apparently surfaced across Wall Street to try and make sense of this unpredictable environment: the taco trade.
The taco trade. That's intriguing. What's the backstory there?
Well, according to Yahoo Finance, it's an acronym, right?
Yeah.
Standing for Trump always chickens out. It reflects a belief, or maybe an assumption, that despite tough rhetoric on tariffs, it often doesn't translate into sustained, forceful action.
Okay, so the market essentially learned to bet against the toughest talk then, sort of fade the headlines.
Precisely. This assumption that tough talk would lead to de-escalation actually fueled a significant market tailwind in recent months. Yahoo Finance noted that the initial U.S.-China tariff de-escalation earlier this month was a key trigger point.
And we saw the results, right?
We certainly did. Stocks rallied hard. Yahoo Finance and MarketWatch both highlighted that the S&P 500 had its best May since 1990 and its best month overall since November 2023. CNBC also pointed to this strong performance.
But that market confidence, that taco trade thesis, seems to be getting seriously tested now, based on the recent headlines you sent over.
It certainly hit turbulence last week. Yahoo Finance reported a post on Truth Social from President Trump accusing China of having violated the trade deal.
Okay. And then came reports of potential new restrictions.
Yes, Yahoo Finance also mentioned reports that the administration is looking to expand tech restrictions on China, specifically by targeting subsidiaries, apparently to prevent companies from sidestepping existing rules.
How did Beijing react to that? Predictably, I imagine?
Yeah. Sources like Yahoo Finance, MarketWatch, and CNBC reported a swift and sharp response. China accused the U.S. of breaking the tariff truce and vowed resolute and forceful measures in retaliation.
So, escalating accusations on both sides. Is there any indication in the sources of dialogue to maybe, de-escalate? Any off-ramps mentioned?
Well, Yahoo Finance and CNBC did mention the potential for a call between President Trump and President Xi Jinping this week. MarketWatch also noted that as a possibility that could help iron out issues, as they put it.
Okay, potential talks. But meanwhile, specific new tariff actions are being proposed, according to these reports.
Yes, that's right. CNBC and Reuters highlighted President Trump, stating he intends to double tariffs on steel imports to 50% from the current 25%. This move is set to be effective June 4th.
Wow, doubling down. And how is Europe reacting to that particular shot across the bow, the steel tariffs?
Not positively. CNBC reported the European Union criticized the steel tariff hike, arguing it undermines wider trade negotiations they're having with the U.S. and will simply lead to higher costs.
And they threaten countermeasures.
They explicitly stated they are prepared to impose countermeasures. And Reuters added some context from the ground, quoting the CEO of Germany's second biggest steelmaker, Salzgitter.
What did he say?
He warned that Washington's tariff policy is hitting European industry hard and, interestingly, causing increased import pressure on the e-market from cheaper Asian steel. So, sort of a knock-on effect.
Right, unintended consequences. So you have Direct policy threats, international friction, and, as Yahoo Finance and MarketWatch reported, even legal battles over existing tariffs adding to the mix.
That's right. The sources discussed a trade court actually striking down a significant portion of the prior administration's tariffs, citing legal flaws in how they were implemented.
Okay, so tariffs off.
Well, hold on. That was quickly followed by a federal appeals court pausing that decision. So essentially putting the tariffs back in place temporarily while the legal process continues. U.S. Treasury yield sources also noted this legal back and forth just adds to the uncertainty.
It's a complex brew, isn't it? Policy pronouncements, geopolitical tension, legal challenges, all swirling around. And as Yahoo Finance highlighted, this constant state of policy pivots and uncertainty is a real concern for investors and businesses. Why is that overhang such a problem, according to them?
Well, Yahoo Finance suggested that this uncertainty puts a damper on investment, capital expenditure and also M&A activity. Companies hesitate. It even mentioned potential impacts on credit markets, particularly sub-investment grade markets, as lenders might become more cautious. It just makes long-term planning very, very difficult.
Yeah, you can see why. So with that backdrop of tariff tension and uncertainty, how are the markets actually behaving today, Monday, June 2nd, according to the sources?
Well, stock market today, CNBC and U.S. Treasury yield sources all noted U.S. stock futures were pointing lower this morning, signaling a cautious, maybe tepid start to June after that really big rally in May.
Okay, a pullback. How did Asian markets respond overnight to the latest headlines?
CNBC Asia Pacific and stock market today indicated Asian markets were mostly lower. The Nikkei in Japan was down about 1.3%, the Topix down 0.87%, Hong Kong's Hang Seng fell 1.2%, India's Nifty 50 was down slightly, 0.1%, South Korea's Kospi was nearly flat.
And specifically on steel, how did those stocks react to the tariff news over there?
Yeah, CNBC Asia Pacific noted direct impacts. Steel stocks in Japan and South Korea mostly fell. JFE Holdings down over 1%. Kopi Steel down a bit. Hyundai Steel dropped 3%. POSCO Holdings declined 1%.
Any outliers?
There was one interesting one. Nippon Steel actually climbed 1.58%, apparently after President Trump reportedly called them a great partner to U.S. Steel.
Huh, interesting nuance there. Okay, shifting west, what did European markets do on Monday morning?
Europe's stock markets, live reported European bourses were also retreating. The regional stocks 600 index was lower by about 0.25%, with significant declines in areas like autos down 1.75% and technology down 1.2%.
And that was linked to tariff fears.
Yes, the sources linked this weakness to fears of escalating U.S.-EU tariffs. The UK's FTSE 100 was a slight exception, pushing a bit higher, apparently helped by rising oil and gas stocks.
Okay, so a generally cautious start to the week globally. Yet, you mentioned some on Wall Street. We're still betting on the taco trade paying off, still buying the dip.
Right. Yahoo Finance highlighted that for many, particularly it seems, retail traders who've been actively buying the dip, betting on eventual tariff de-escalation, has been profitable. It's worked.
But is that strategy sustainable in this kind of environment? Are people getting nervous about it?
That's the big question now. Sources like Yahoo Finance and Stock Market Today quoted Julie Beal, chief market strategist at Kayne Anderson Rudnick. She warned that the market's vocal embrace of the taco trade, calling it out like that, might actually prompt President Trump to bear down a little bit more, as she put it. Her concern is that calling out the pattern could reinforce his inclination towards tough stances, potentially increasing uncertainty rather than diminishing it.
That's a fascinating dynamic, the market's own narrative potentially influencing policy outcomes.
Wow. Okay, beyond the tariff tension, what other key economic signals are highlighted in the sources that investors should be watching this week?
Well, Callie Cox, chief market strategist at Ritholtz Wealth Management, was quoted in Yahoo Finance, urging investors to look beyond the sort of tariff drama towards fundamental economic data. She specifically mentioned the labor market.
And the big labor market report is due this week, right? Friday.
It is. MarketWatch, Stock Market Today, and U.S. Treasury yields all pointed to the May non-farm payrolls report on Friday as a really critical data point. It's expected to offer fresh clues on how things like tariffs and interest rates are shaping the broader economy.
Any underlying worries about the labor market mentioned? Yeah, Yahoo Finance also referenced their chart of the week, noting ongoing concerns that the labor market might be worse than it appears beneath those headline numbers. Something to watch.
Okay. And earnings season is mostly behind us. But are the sources indicating any shifts in how analysts are viewing the current quarter Q2?
Yes, MarketWatch noted that despite solid earnings for Q1, Wall Street seems to be getting more cautious about the second quarter. They highlighted that analysts have trimmed S&P 500 earnings per share estimates more than the historical norm lately.
How much more?
A 4% cut from March 31 to May 29, compared to a 5-year average cut of 2.6% and a 20-year average of 3.1%. So a noticeably bigger trim, suggesting less confidence perhaps in the immediate outlook.
Are there any specific companies or sectors being watched this week for earnings that might shed light on these trends, maybe tariff impacts?
Definitely. MarketWatch mentioned several retailers reporting, which will be key to watch for commentary on potential tariff price increases or, supply chain flexibility.
Well,
That list includes Dollar General, Dollar Tree, Victoria's Secret, Ollie's, Five Below, Petco, and Rent the Runway.
and any specific concerns flagged?
Apparently, analysts have specific concerns about Victoria's Secret, mentioning sector headwinds, competition, potential tariff impacts, and even cyber issues.
Wow, a lot going on there. Any other big names reporting?
Yeah, other notable names reporting this week, according to MarketWatch, include Campbell's, Brown-Forman, Mission Produce, Vail, HPE, CrowdStrike, Broadcom, and DocuSign. A pretty varied group.
Okay. We also saw some data on manufacturing activity from different parts of the world mentioned in the sources. How did that look? Was there a clear trend?
Not really clear, no. Reuters provided a snapshot showing a pretty mixed global picture, and in some cases, hints of tariff impacts.
For example?
Well, the downturn in Eurozone manufacturing eased in May, getting close to stabilization. Japan's factory activity contracted, but at a slower pace, still below that key 50 mark, indicating growth. Australia's manufacturing sector actually shrank for the first time in 3 months.
And what about Asia, particularly with the tariff focus?
Right. Notably, South Korea's manufacturing output fell at its steepest rate in 31 months, and Reuters explicitly mentioned sources partly attributing this contraction to the continued impact of higher U.S. tariffs, both domestically and on their key export markets.
So different regions responding very differently to these global pressures, with tariffs clearly playing a role in some cases. Interesting. Let's turn our attention to some other key financial markets. What did the sources say about the bond market? Treasury yields.
U.S. Treasury yields, sources indicated yields were ticking higher this morning, Monday morning. The 10-year yield was up over 2 basis points to around 4.445%, and the 30-year yield was over 4 basis points higher, nudging towards 5% at 4.981%. The 2-year yield was relatively flat.
Okay, yields moving up. What did the sources suggest is driving that?
U.S. Treasury yields and Fed's Waller-Bloomberg sources linked this rise to a couple of factors. One, rising concerns over the U.S. fiscal deficit. And two, also increased risk aversion among foreign investors, which is often fueled by the kind of trade and geopolitical developments we've been discussing.
Did any sources offer a view on where yields might be headed, or maybe what rising yields mean for stocks right now?
Yes. MarketWatch referenced Goldman Sachs strategists. They expect 10-year yields around 4.5% by year-end, but they offered a nuanced take on the impact on equities.
How so?
They noted stocks don't necessarily mind yields rising if it's due to strong growth expectations. That's okay, but they become much more sensitive, more vulnerable if the rise is driven by inflation worries or, crucially, fiscal worries like those deficit concerns.
And small caps versus large caps.
Right. Goldman Sachs also highlighted that small cap stocks are particularly vulnerable to bond market volatility compared to large caps, mainly because their debt structure often involves more floating rate debt with shorter maturities, making them more sensitive to rate changes.
That makes sense. And there was an interesting detail about Warren Buffett's Berkshire Hathaway in relation to treasuries, something about T-bills.
Yes, CNBC Daily Open and a reference in that Goldman Sachs piece mentioned a JP Morgan report. It highlighted that Warren Buffett's Berkshire Hathaway has significantly increased its holdings of T-bills, short-term treasury bills, basically doubling its ownership.
Doubling. Wow. How much do they own now?
JP Morgan estimated Berkshire now owns 5% of all short-term treasuries.
5%. That's huge. Could be seen as a safety play amid uncertainty, maybe?
Could be, or just managing a massive cash pile. But it's definitely a notable positioning highlighted in the reports.
Okay. How about the U.S. dollar? What's the story there, according to your sources?
The dollar appears to be weakening against a range of currencies, according to the sources. Morgan Stanley, an analysis picked up by Bloomberg, predicted the U.S. dollar index could fall around 9% to 91 by the middle of next year. JP Morgan is also reportedly bearish on the dollar.
And what's driving that dollar weakness, according to these reports? Why the bearishness?
Well, Morgan Stanley and Europe stock market's live sources attribute it partly to President Trump's disruptive approach to trade, which creates global uncertainty and maybe a potential rethinking globally about over-reliance on the greenback as the reserve currency.
So which currencies might benefit?
Morgan Stanley sees currencies like the euro, the Japanese yen, and the Swiss franc as potential winners. And Europe's stock markets live noted that sterling and the euro were both higher against the dollar this morning.
Okay. And gold, the classic safe haven asset. How's that doing amidst all this tension?
Gold is surging. Bloomberg and Europe's stock markets live directly linked the rise in gold prices to increasing global tensions. They specifically cited the U.S.-China accusations we discussed and also escalating fighting in the Russia-Ukraine war as boosting demand for the haven asset.
Any strategic view on gold mentioned?
Goldman Sachs, according to Bloomberg, views gold as a useful hedge against inflation for long-term portfolios, so both a tactical safe haven and maybe a long-term strategic holding.
Got it. Now, something else that really stood out in the sources was the performance of European equities this year. Quite different from the U.S. picture.
It's a very clear story of outperformance, yeah. Stock Market Today highlighted that European equities have been clear winners globally this year, significantly outpacing the S&P 500. The stock's 600 index specifically is beating the S&P by a record 18 percentage points when measured in dollar terms.
18%. That's a massive gap. What's behind that strong showing from Europe, according to the sources?
Well, Stock Market Today connected it partly to Germany's historic fiscal spending plans, providing a boost, and also the impact of a stronger euro helping returns in dollar terms.
And investor sentiment.
The sources also noted that market participants seem to see more potential in the region due to resilient corporate earnings and, importantly, more attractive valuations compared to the U.S. market, which is grappling with these concerns over trade policy and fiscal debt. It seems Europe is being seen as a relatively safer bet right now.
That's a really big contrast to the U.S. picture we've been painting. Let's bring in the broader policy and political context highlighted in the sources. We touched on tariffs, obviously, but there's also movement on U.S. fiscal policy, tax policy.
Yes, CNBC's reporting detailed the House GOP's tax and spending package, which they've apparently dubbed the One Big Beautiful Bill Act, a memorable name.
Indeed. What's in it?
It incorporates many of President Trump's prior tax cut proposals, aiming to make the 2017 tax cuts permanent and adding some new tax breaks as well.
But the sources suggest this bill faces some hurdles. It's not a done deal.
Absolutely not. Significant debate is expected in the Senate. Areas like the limit on the SALT deduction, the state and local tax deduction are particularly contentious.
How so?
The House bill approved raising the cap to $40,000, but experts cited by CNBC expect that figure to be negotiated lower in the Senate. There's also potential debate over expanding the child tax credit.
And the cost. Deficit impact.
Right. CNBC also noted concerns from fiscal hawks who worry the bill could significantly increase the deficit. An earlier version was estimated to add something like $3.8 trillion over a decade.
And how are they trying to pass it?
The bill is being advanced using the budget reconciliation process. That's a mechanism in the Senate that allows certain spending and tax bills to pass with just a simple majority, bypassing the usual 60-vote filibuster threshold, though it has strict rules about what kind of provisions can actually be included.
Okay, complex legislative maneuvering there. Elon Musk is also mentioned in the sources in relation to government efficiency initiatives.
Right.
What's the story there?
Yes, reports in Musk says and Stock Market Today covered the end of Elon Musk's role leading the Department of Government Efficiency, or DOGE, as it was known.
Right, DOGE.
While described as a supporter of the previous administration, Musk reportedly expressed disappointment with the House GOP's massive spending bill, that tax package we just discussed.
Why the disappointment?
Musk was quoted as saying it undermines the work that the DOGE team is doing on efficiency and savings.
And did the DOGE initiative actually meet its goals according to the sources?
Yeah.
Did it achieve those big savings targets?
Well, Musk reported that while DOGE did oversee cuts of tens of thousands of jobs, it fell well short of Musk's initial, very public target of $2 trillion in savings. The initiative also apparently faced criticism and, as Musk himself described it, became a kind of whipping boy during its run. An opinion piece in Opinion Rubini also referenced DOGE falling short of its stated target.
Okay. Finally, speaking of opinion pieces, there was one in MarketWatch offering an interesting framework for viewing potential policies, particularly economic impacts.
Yes, this specific opinion piece by Nouriel Roubini distinguished between potential policies that could be seen as leading to higher growth and lower inflation, things like tech innovation support,
Right.
deregulation, tax cuts, and those characterized as stagflationary.
Okay, what did the author identify as potentially stagflationary policies in that piece?
The author argued that protectionism and tariffs, immigration crackdowns, unfunded deficits, threats to the independence of the Federal Reserve, and attempts to weaken the dollar could be viewed as stagflationary,
Gaming.
meaning they could potentially lead to slower economic growth combined with higher prices. Stagflation.
Did the piece suggest any forces might counteract these potential stagflationary pressures? Any checks and balances?
It did. The author argued that market discipline, things like the higher bond yields we just discussed, reacting to fiscal concerns, and the independence of the Fed act as important constraints on such policies.
Interesting point about the Fed.
Yeah, the piece controversially suggested that the Fed not cutting rates right now is actually doing the previous administration a favor, in a sense, by anchoring inflation expectations and preserving the option to cut later if the economy weakens significantly down the road.
And immigration.
The author also specifically argued that policies reducing the labor supply through immigration restrictions could put upward pressure on wage growth and, consequently, inflation.
Okay. And again, just to be clear for everyone listening.
Yes, it's crucial to reiterate this was an argument presented within one specific opinion piece in MarketWatch. It's offering a particular viewpoint on the potential economic impacts of different policies, not presented as a factual statement by us or the show. We're just reporting the perspective presented in that source.
Right, exactly. Thanks for making that distinction clear. Okay, stepping away from the core market and policy focus for just a moment, the sources you shared threw up a couple of other really interesting headlines from around the world that are probably worth noting. Little side stories.
Absolutely. One that definitely caught my eye, reported by the Associated Press, was that the Damascus Stock Exchange has reopened.
In Syria. Wow.
Yeah, after being closed for 6 months following the civil war. The Syrian finance minister stated it signals economic recovery. This apparently follows an easing of some international restrictions, with the U.S. and Europe lifting some sanctions last month.
Any other signs of activity mentioned?
The report also mentioned a recent $7 billion power deal with a consortium involving Qatari, Turkish, and, interestingly, U.S. companies aimed at revitalizing the country's electricity grid. It's a piece of potentially positive economic news from a region that's been undergoing immense turmoil, suggesting maybe a potential shift, according to that source.
That is unexpected news. Anything else interesting on the global tech or regulatory front?
Yeah, Reuters reported on Germany's financial regulator, BaFin. They're now using artificial intelligence, AI, to help spot market abuse and suspicious trading patterns.
AI for market cops.
Essentially, yes. And its president warned that with this new tech, the chances of getting caught trying to manipulate markets are now significantly higher. It's an interesting look at how technology is being deployed in market surveillance to enhance regulatory efforts.
Definitely something to keep an eye on. Okay, so pulling all of this together and bringing it back to you, our listener, this deep dive into your stack of sources really highlights several critical and very interconnected areas driving the current market environment.
Exactly. I mean, we've seen how the ongoing tariff volatility, the TACO trade being questioned, the U.S.-China accusations flying back and forth, the specific steel tariff move and Europe's reaction, even those legal battles over existing duties is a primary source of uncertainty directly impacting markets and specific sectors globally.
And we've also looked at the signals beyond just the policy headlines that shift towards caution among analysts regarding Q2 earnings, and the really critical May jobs report coming later this week, which should give us a broader economic pulse check. These data points are essential counterpoints to the daily policy drama, aren't they?
They really are, and we explored how these dynamics are playing out in other key financial markets. Treasury yields rising, partly due to fiscal and risk concerns, the dollar weakening, perhaps partly due to trade uncertainty, gold surging as that classic haven asset, and really interestingly, European equities significantly outperforming, maybe seen as a relative safe harbor from some of these U.S.-centric policy risks.
And all of this, as you said, is happening against the backdrop of complex U.S. fiscal policy debates, like that House tax bill and its hurdles, and the political commentary, such as that opinion piece's argument about potentially stagflationary policies and the market constraints that might exist.
So the core takeaway from this stack of sources isn't just the list of headlines, right? It's the realization that these factors are deeply intertwined. Navigating this environment, as your sources make clear, requires paying attention to a really wide spectrum of signals, everything from tariff tweets and court rulings to earnings calls, jobs reports, bond yields, and currency movements. No single piece of information exists in a vacuum here.
It certainly doesn't. And it kind of leaves you with this big, maybe provocative thought to consider, doesn't it? In a world where major policy decisions seem to shift so rapidly, can even end up in court, and where different parts of the global economy are reacting in such contrasting ways, how does one build resilience or even find opportunities? Does the taco trade thesis breaking down, if it is, mean we're entering a fundamentally different regime for how policy impacts markets?
Those are definitely the big, complex questions that the sources raise, but don't necessarily answer definitively. Lots to mull over.
Indeed. Well, that was a fantastic deep dive into the material you provided. Thank you for sharing these sources with us and letting us explore them together.
Always good to dig in. We'll see you all tomorrow morning with new headlines from major financial magazines.